Hey, what's up guys? TrackFX here, back with another video, and today we're going to be going through order blocks, how to find order blocks, what an order block is, and when order blocks are not useful. Now, firstly, before we do get into this video, I just want to simply say I'm not your financial advisor. I'm not giving out any financial advice. I'm simply just giving out information, public knowledge that could be found on the internet. I'm not telling you to invest anything. Everything you do it at your own risk. Now that we got that aside, I'm gonna get into what an order block is before we actually get into some real life examples. So an order block is initially when, so let's say the market is selling off, right? It's in a downtrend market or uptrend, doesn't matter, but let's say we're in a downtrend market right now, right? And then out of nowhere, we just have this significant pump in price where we have an impulse move towards the upside, breaking multiple lower highs. Doesn't have to be multiple, but the more the better. So we breaking lower highs. Now, the last down candle, the last bearish candle before that huge push towards the upside is considered as your order block, specifically because that last down candle is where the sell side orders stopped, and that's when the bank started pumping money in pumping buy orders to move the market up. Now, if that's a little bit confusing to the people, right? Well, I don't really like to confuse people. I think simplicity is the most key to trading. So if that's a little bit confusing, what you could say is, okay, so the market was selling off, and then out of nowhere it just had a huge pump in price, right? And you don't need to know exactly why, but it had a huge pump in price. Now, what you need to know now, which is crucial, is highlighting the last down candle, the entire of the last down candle, right, as a zone like we did over here, and expecting the market to retest it, right, retest that level. And this is called mitigation. Now, mitigation is when the banks are closing their previous orders to pump more money into their new orders. So for example, they're closing their sells, right, and then they're retesting this to close their sells to pump more money into buys. But if, like I said, if that's confusing, all you need to know is that they're retesting this level because it's an untested level, and there's a lot of volume in this level. As you can see, it moved up once, so we're assuming it's going to do the same thing again. Now, this same concept that I just used is same thing for sells, buys, everything. But I'm going to show you some real life examples now. So delete this. Getting to the real life example right over here. I was actually recording before my mic wasn't working, so I had to get everything back. But like I said, like we said, an order block is basically when out of nowhere there's just a pump in price. As you can see right over here, the market was selling off significantly. Retesting, moved about 90 pips, and then out of nowhere in this area right here, we had a huge push towards the upside. Now, this impulsive move, before that impulse, what we're going to do is we're going to highlight the entire down candle, the last bearish candle, and highlight that. Now, this is my zone. Now, we can delete this. Let's actually move back, replay. So, like we said, this is our zone. Now, market came, pushed down to the zone, and let's play the next candle, and we see bullishness. Now, what a lot of people end up doing is they end up taking longs right away, right? They end up entering, having a limit right there with their stop loss below. But in my opinion, the problem with this is you don't really know if this order block is going to hold, or if this move right here is just a push up before we continue going lower to test other order blocks. So this is why, instead of entering right away blindly, you should, go on the smaller time frames. And like I said in my last video, look for the break of structure. Now let me actually go back right over here. Like I said, look for the break of structure of lower highs. So let's get our confirmation list done. First confirmation, we have market coming in our order block and is reacting pretty nicely. We're seeing bullish pressure. Now after this long bearish structure being formed, right, this long bearish structure, we can see that there's a change in trend. We can see that the market is forming bullish structure. And now, now our third confirmation is that we broke a previous lower high right over here. Now, after we broke a lower high, what did I say? I said in the last video that you want to highlight the level that broke the lower high. So as you can see, this is the expansion that broke this lower high. So what we're gonna do is we're gonna highlight this zone right over here. Now, if you pay attention, you can see that, like I said, we have this last down candle before this huge push towards the upside. So this is considered as our order block right over here. This is our order block. Now, you can call this the 5-minute POI. That's what I like to call it, the 5-minute point of interest. Now from here, all you do is wait for price to come down into this level, and now you can do multiple things. Now with order block entries, what you could do is you could either enter on the open of the bearish candle right over here and have your stop loss at the low. Now that's more of an aggressive entry, so it'd be like this, right? Now a second thing you can do is take your Fibonacci out and measure the entire order block, and your entry could be the 50%. So your entry could be the 50% right over here. Now this is a more conservative entry, you know, you're giving the trade more breathing time, you're waiting for it to pull back more so you can get a more accurate entry, while the open is more of an aggressive entry. I'll show you more examples after this one, you know, to get a good understanding. But for me personally, I don't care. I usually always enter at the open right over here with the stop loss at the low, and you know, take profit. Usually just realistically I would hold it right up to here. That's all I would hold it to. But from here, all I do, wait for the trade to come. And so I think we did get stopped out right over here. Let's take a look. Yeah, we did end up oh no, we didn't. It missed the stop loss by like not even a pip, by like 0.1 pips. So yeah, so that's how the order block works basically, right? Like we had our higher time frame order block right over here. I'll go through that one more time. We had our higher time frame order block right here, and then we dropped down towards the 5-minute time frame after the market came into our zone, and we saw that it created a second order block. So what's really important to know is that an order block can be created inside of another order block. So like I said, this entire zone is a 4H order block over here, right? Now what happened when the market came into this zone, we created a second order block right over here that broke structure, right? And it came over here, missed our stop loss by 0.1 pips, and then just continued up for about like a 13-to-1 risk to reward ratio, which is pretty good. So that's how order blocks work. Now I can show you how to spot them now. Now in my opinion, for an order block to be valid, it has to break structure. So for example, you know, if we're in a buy side market and I know that I'm looking for buys, I'm not going to be focusing on an order block right over here, right? Because look, it meets our recommendations and matches. You know, we have this up candle before a huge push towards the downside. But why isn't this valid? Well, it's because we're in an uptrend market. Like I said, if you're in a buy side market, don't look for sell side order blocks. Because if you can get the mindset of only looking for buy side order blocks, then you're eliminating half of the confusion already. Because imagine if I'm looking for buys, but then I start looking for sells. I would think about, you know, selling right over here, you know, stop loss over here, and then take profit below. And that, you know, you'll see what ends up happening is you just get stopped out. And a lot of people get confused on why this ended up happening. Well, it's because we're in an overall bullish market, which you don't want to you know, go against. So that's an idea of, you know, the order blocks that you don't want to take. You know, if you're in a buy side market, don't look for sell side order blocks unless there's a lot of bearish structure on the higher time frames forming. So for example, you know, if we're breaking multiple key levels of structure like here and here, then a great example would be, okay, yeah, then it makes sense to look for sell side order blocks. But you know, that aside, another example that I'm seeing right over here, if you see right over here on the 4-hour, you can see that we were pushing down. You know, we were pushing down from here. You know, we were selling down. Now, eventually, right in this area right over here, we pushed up. Now, like I said, we broke structure right over here, and we had a huge push towards the upside out of nowhere. So what I would do is I would highlight this order block right here. Right, I would highlight that entire order block, and then before the market goes into the zone right here, what you could do is you could go down to the, you know, a smaller time frame such as the 1 hour to refine it. Now a refined order block just means an order block inside of an order block, right? Now this may be a little confusing, but look at this. If you were to take this order block, right, from the high to the low, that's a 100 pip zone, which is really like big. And if you were to enter here, your stop loss would be huge, which isn't, you know, we don't need that. So what you could do is go down to the 1 hour time frame, and what do you see? Well, what I'm seeing is that we have this order block right over here. We have the down move, right? We have this down move before the huge impulsive move towards the upside. And what do we also have? We have a higher time frame breaker structure. So we have two of the confirmations met. All we need now is price to come inside of this order block, and either we can enter on the open, the 50, and yeah, that's basically it. So I always enter at the open, like I said before. Stop loss would go below for about 31 pips. Now this is pretty big, but we are trading on the higher time frames now, so it does make sense. And then your target would be 200, so it's a good 7-to-1 risk to reward ratio. So automatically we do get tapped into the pip, and boom, exactly just hit T. Oh, not yet. But yeah, basically hit take profit right over here for about 233 pips. So I hope that was a good understanding of order blocks, and like I said before, this is another example of not using the wrong order blocks. Now over here you can see that there's a sell side order block right over here, right? But what did I say? We're in a buy side market. So now the odds of this order block playing are pretty low, but that doesn't mean it won't play out. It just means that it's really low and it won't be in your favor. The odds won't be in your favor. But because we are in a buy side market, it wouldn't make sense for us to look in sells over here, because what could easily happen is the market comes in here, rejects, gives you your confirmation, sells off a bit, keeps you happy, and then boom, takes you out, right? And that's what happens to a lot of people, and it happened to me. And this is why I stress that don't use order blocks that go against your initial bias. The most important thing is sticking to your bias, sticking to what your initial bias. So before you enter a trade, ask yourself these questions: am I in a buy side market? Are my confirmations met? Do I have the rules? Psychology, risk management. You want to ask yourself all these questions before you enter the trade. Or things like this could end up happening. You enter over here. You get a nice entry over here. You're probably holding that. A lot of people would hold this all the way down to here, but look what ends up happening. It goes down your way, but then stopped out, just like that, stopped out. So this is why you don't want to use order blocks that go against your way, your trend. That's basically it. I can give you guys another example of how order blocks look like and how to identify them. No, this one did not get tapped, but because this is live, I'm not using any pre-examples. I want to make this live as possible, most realistic, so this could take some time. Right over here, now this is an example of a sell side order block working out. So as you can see, we are in a bullish market. We're in a bullish market. Now we broke some structure towards the downside significantly on the 4-hour. We broke this lower high, and that's not a lower, higher low. We broke this higher low, and we broke this higher low. Now this does give you a lot of confirmation that the market could potentially be selling off down for a bit. Now the only reason I would take this order block is because we broke strong 4H structure. So if we take our zone out, you can see that we have this last up candle before the huge down move. All that's left is the market to come inside of our 4H POI. And after it comes into our 4H POI, you guys know the drill. Look for the the rejection, breaker structure, continuation. Markets in our 4H POI go straight to the 5-minute time frame. Alright, and all that's left, you guys know what's left. Just look for the lower high to be broken right over here, and then now you have two order blocks. You can either enter over here. I'm gonna make this a different color, make this a blue entry, or you could enter right. If you go towards the 4-minute time frame, you can enter 3 minutes to get it. Yeah, you can enter over here. You have 3. Now this one kind of got tested, so I would probably go where the untested level is, which is right over here. Stop loss just over here, and then take profit potentially wherever you would like. I would most likely hold it to here for about 40 pips. If this one does get stopped out, we still have our second level of interest, which is just over here. So as you can see, we have two order blocks now. Now you might ask yourself, which one are the correct order blocks? Well, the thing is, you don't know which one's going to be the right one, because for all you know, this trade doesn't even need to pull back here. It could automatically just continue going down. But this is a game of probability. Which ones, like there's a 50% chance of this one being correct, 50% chance of this one being correct, but you won't really ever know. So this is why it's all about probability. So if we do risk about 1%, right, if we risk about 1% on this one, on this trade right over here, and we get stopped out, well, we still have this trade over here that we could risk another 1%, and that could potentially make back the loss we made over here and even a lot more. But let's see what ends up happening. Okay, so like we said, it didn't need to come back down inside of the order block, but for the people who just entered off of this order block right over here, it played out perfectly. But this is an example of not chasing your trades, right? So this is where psychology comes in, right? You shouldn't really chase the trade that that you missed, Because for all you know, right, if you're chasing the sell all the way back down, and let's say, you see this order block right over here, people are, you might think of selling, but guess what? The market just went up. If it moved from your initial point of interest and didn't tap you in, leave it. There's another day to look for trades, leave it. That's it. That's pretty simple. That's how to find which order blocks you should use, which ones you shouldn't use, how to avoid fake outs and everything. But thank you so much for watching. I hope you guys understood. If you guys have any questions, please leave a comment below and I'll get back to you as soon as possible. Thank you. Have a good day.